Thank you so much for joining us on the Dwelling Show. I'm your host, Ola Dantes. We've got an amazing guest with us today, Anthony Scandariato, right? I hope I got that right.
Close enough.
Close enough, right? So, Anthony, I'm sure you can do a way better job than I can. Just kind of tell our listeners a little bit more about who you are and kind of what you've been up to lately, actually.
Charlotte, thank you so much for having me on your show. I really appreciate it. And I've been following you for a while, so it's definitely good to be on your show. So again, thanks for having me on. My name is Anthony Scandariato, so you're close enough. And I run a company called Red Knight Properties, and we're a multifamily sponsor specializing in middle market apartment buildings and also mixed use as well. We have about 260 units under management, kind of in contract that are closing within the next couple months. We currently have 200 units in our portfolio, about 30 million in AUM. So closing on another 60 or so in the next couple months, and we are pretty much vertically integrated. The only thing we don't do in-house is construction. But we do property management, asset management, and we're really focused on, value add properties. We call it the workforce housing segment, where, we're based in New Jersey. So our properties are within the tri-state area. At this point, I own in basically Jersey, New York, and Pennsylvania at this moment. And, we're buying, kind of garden style 2 to 3 story apartment buildings with deferred maintenance, below market rents, sleepy ownership, and really going in there and creating value through strategic improvements and renovations, to get the rent roll up to a level that was not performing on the financial side, but also to, improve the community and the surrounding area by making some substantial exterior and interior renovations and elevating the community's perception of, the properties, and obviously that increases property values all around. So generally how we structure deals, it's through a syndicated format, which I'm sure a lot of your listeners are familiar with, which is what you focus on as well, to my understanding, we have basically what that means is, a group of investors pooling their financial resources together to buy a larger apartment building. And generally our deal sizes, at least for me right now, are like 5 to 20 million. So when you acquire apartment building, usually down payments are anywhere between 1 and 2 million per deal. So I don't generally come up with the money fully myself, or I would love to, but generally I come up with some of it with my partner, and then we, raise the rest from our friends and family and our immediate
Investment
networks,
pool.
to
Yeah.
partner with us.
I mean, I think before we even kind of do a deep dive, I think we should talk a
Sure.
little bit about kind of how you got started, right? So, folks might be thinking, wow, 260 units, that's, amazing. I'm just trying to get my first, duplex, or maybe my first 10 unit apartment. So how did you get started in the syndication or multifamily space?
So now that you have the framework of what we're sponsor for about 5 years prior to forming my company, Red Knight Properties. So when I did that, I really learned the business, and I was able to understand how deals are put together, and how they're structured, and was able to essentially, in some regards, model what they were doing and apply it to my own business. But for somebody just starting out, there's many different ways you can start out. Me personally, I started out with a duplex property that I bought on my own. It was a smaller investment, and really turned the building around quickly, and bought a couple more duplexes, and then kind of moved on to bringing on another partner. So I understood how that worked when you have other investors on a small property. Like I said, these are duplexes right now. And, we sold a couple of them, we refinanced a couple of them, and the returns were, pretty good when, you can generate a 40% return in 18 months and nobody complains. So, we kind of just, I realized this was too small, that the duplexes aren't really going to scale me for where I want to be, which is essentially to be financially free. Um, and, was able to scale up from there by buying, after the duplexes, kind of 10 units here, 10 units there. This is all while working the full-time job, by the way, to try to build up the cash flow, and the portfolio and kind of your track record before you go out and, try to do it essentially on your own with
Right.
your team.
Right.
So that was really
So
important to me. Yeah.
so you jumped from the duplex, you bought a couple more, and then you said you went to a 10 unit next?
Yeah. So the duplex was me. And then the second one was a duplex with me and another partner that we sold. And then the next one was a 10 unit with a different partner, who's now my business partner, for Red Knight. And we bought that, and then we refinanced it a year later. And we pulled out like 140% of our investment on that. And then after that, we bought a bunch of other 10 units here. We bought like a 13 unit, and then we bought a 20 unit, then we bought a 12 unit. So we bought collectively together about 70 units, my current business partner and myself, just together in a simple joint venture partnership. And then that's when we started, once we had some of the refinances and sales, started bringing on other, partners, to invest with us for larger deals.
Makes sense. Makes sense. Yeah, no, I really like that. But you also talked about partners and partnership. So, for those kind of listening and trying to replicate, your success, what are the things that you looked at, before you chose your partner or your partners?
Yeah. So a couple of things that I looked at, obviously you have to um, trust the partner you're getting into business with, because it is a marriage and real estate is a long-term game. Even if you're, flipping the properties, it's still a financial investment. And you really have to trust and really, really value the person that you're either acquiring the property with, or even your group of investors in a syndication. Pretty much, and we don't have to get into this on the show, but I specify in 506Bs at the moment. So I have to have a pre-existing relationship with each investor per the SEC. And to be honest with you, I kind of want to have relationships with them anyway, because I want to know who I'm going to be reporting to, essentially, because you're really working for your investors at the end of the day. And if one is going to annoy me at 3 o'clock in the morning because a basement space isn't leased, I really don't want to have them as a partner. Um,
Right.
so, I would say it's very important for you to get to know your partners and, manage your levels of expectations, especially if you're at the syndication game, or even if you're just starting out, just manage the expectations. And I always try to set reasonable expectations when it comes to returns, because when you blow it out of the water, people are very, very happy. When you underperform, it's doesn't paint you in a good light. So I try to be very reasonable and under promise and over deliver.
Yeah, I like that. I like that. So, you did pretty well, obviously, like you said, refied some of these properties, and then I'm guessing, went into bigger assets, and then you started syndicating deals, right?
Yep.
So, did you have to get a mentor, to kind of go over that kind of, less than 50 to, bigger buildings, or you just kind of self-learned all the concepts yourself? Or what was that process like?
Yeah, I mean, the mentorship was, I was fortunate enough to get hired by um, a real estate sponsor, before starting this. And I worked for them, and I basically ran deals for them, acquisitions, helped out a little bit with asset management and property management and development. So that was my mentor, that was my learning, that was my education. Obviously, it was a job too, but I really learned a lot from that experience. So that for me was key. um, for those who haven't had that experience or have it, to work for somebody else first, then you can always get a mentorship. Um, there's a lot of different programs. I currently really don't offer one, but in this business, and there's there's so many ways to split the pie and make money and find a role for anybody looking to be active or passive. So there's many different ways to do that through partnerships.
Nice. Okay. So typically in the apartment syndication space, self-management is kind of frowned upon, right? We as asset managers or as syndicators, we just want to shift that burden to third-party property management companies. Similar to you guys, just like in our company, Dwelling, we're now starting to vertically integrate, meaning we're bringing all the functions in-house. And you guys are doing the same. I think you mentioned with the exception of construction.
Yep.
So, why did you guys go that route? Why didn't you want a third party company help you guys with the management, the day-to-day management at least of these assets?
Yeah, because I would say if you get your systems in place in terms of your software and just to streamline the operations virtually to a certain extent, accounting, leasing, collections, there's a lot of different softwares out there. Buildium is the one that we use. There's Appfolio. There's so many of them out there that allow you to, take it in-house. And actually, if you went to a third party, they'll probably use that same software and to manage the buildings for you. And what I would say too is, I'm a young guy. I'm 28, and when I started this, it was probably 26, 27. So I really want to be on the ground and understand everything going on at the property level too, because this is very early in my opinion, in my career still. So for me, it was more of, I want to be on top of the property management because that's protecting the investment, in my opinion. I don't want to just pass off the management, especially when you're doing value add deals, as I mentioned, where we're going in and making some they could be substantial renovations or building additional units, which we're trying to do now. And we're managing tenants and the eviction process to try to get the rents up. A lot of property management companies that I interviewed are not experienced in that. And the only way to get that experience is to live through it. And fortunately and unfortunately, we have lived through it. But we know how to deal with all of that. And then so when we're ready, especially if the business plan calls for a refinance and your plan is to hold the property 10 years after that, or whatever time period, you'll be able to pass the hat off to a third party because you already created all the value and you pulled the equity out, and now you're just sitting on a nice coupon. So I would say it's very important to understand the business plan for the properties that you set up if you're doing it on a deal by deal basis, and really think about if you want to self-manage or not. For the larger units, for traditional syndicator, you're talking 500,000 units where you're partnering with other co-GPs. You may not want to have self-managed properties, because for those larger properties, especially if it's kind of you've been doing this for a while as a syndicator, you really don't need to have the property management in-house. But I think it is important, especially at the scale where we're at.
Interesting. Yeah, very interesting point. So you also, you were able to syndicate, meaning, pull together investors. Obviously, you have to raise the capital. For folks who are listening and thinking, wow, I maybe want to go out and do what Anthony's doing in terms of raising capital. What would you say are the, tactics that has really helped you guys, Red Knight Properties, to raise capital?
Yeah, I mean, you gotta, I say this all the time, and this is one of the reasons why I didn't leave my, job earlier, was the track record. You gotta, have a track record, because if this is your first time for a larger syndication and you're trying to raise a couple $1 million, it might happen, might not happen. But if you don't have any other background to back it up, and it doesn't have to be real estate. It could be, hey, I ran a successful manufacturing business and I sold it for 10 times EBITDA last year. If you had somewhat of a track record, I think you'll be okay. In terms of capital raising, they kind of come from, for at least at least for me, a lot of referrals. So existing investors refer a friend and they refer a friend. That's kind of how it's been working, especially if you're producing and you're generating returns. Um, obviously, I run a podcast too. If you want to check out my podcast, Discovering Multifamily, that helps as well in terms of brand awareness and just I do it just to educate myself and to educate my listeners. But in return, I do get a couple of interested parties that invest in a couple deals. And networking is key too. Like I said, everything's 506B, and there's two differences with the SEC. And the key difference is pre-existing relationships. So, networking is key, and whether a lot of that's been, at least right now during COVID, or kind of towards the tail end, has been virtual. So through the podcast, through virtual networking events, through consistent social media marketing on LinkedIn, Twitter, Facebook, Instagram. We try to streamline, email marketing. We have an active campaign we set up. As long as you're on the front burner for potential investors or partners pretty much daily in whatever capacity it is, you're gonna get a lot of response.
So we're kind of coming towards the end here. So you've done a bunch of deals. I'm just kind of curious to get you to talk about one of your best deals, if not the best deals. It could be a smaller asset or something bigger, and just kind of tell us the numbers.
Yeah, sure. I think I mentioned there was one I could just mention on a refi basis right now. On a refi basis, there was a mixed-use building. By mixed-use, I mean there was actually retail and apartments above. It was a 10-unit building in northern New Jersey, about an hour outside of Manhattan. And we bought the building. The average rent was $800 for 1 and 2 bedroom apartments, and the market value with no improvements at the building was $1,500 on those apartments. So we were essentially able to double the rent roll in 6 months at that building, without really investing a lot of lipstick. It was a very undermanaged property, and the owner had no idea what the market value was of the apartments, and just kept pouring money into it in terms of renovations, and just never raised the rents because the tenants have been there for 30 years. So it was a great opportunity for us to come in here, and obviously people were not happy when the rent doubled, but you got to be aware of the rent control laws in your area and aware of the market demand. Just be realistic with what kind of rents you think you can achieve. So we were able to double the rent roll, and we refinanced. It was 140% of our equity out after a year, and we still own the building, and we're cash flowing, $2,000 a month.
Nice. Okay. Cool. Yeah. Thanks for sharing that. So you mentioned about your podcast and how that helps you also get investors. I just kind of really want to quickly go back to that. So if there's somebody listening and thinking, hey, I want to start a podcast, right, and just for the purpose of obviously getting investors, would you say that is still a very practical way to get investors, or would you consider other avenues to be something that would actually get more investors? I'm just kind of curious.
Yeah, I'd say it's a piece of the puzzle. I don't say it's a sole piece of the puzzle. And I wouldn't start a podcast just to get investors. I would really do it to educate yourself and to, educate your audience. I wouldn't do it with the sole purpose, because if you have that in mind, then, in my opinion, you're probably looking to fail, because if that's going to be your intention, it's going to turn a lot of people off. So I've always been emphasized on education, because I learned something. Even if I don't get an investor, I learned something from the conversation. So it's not a complete waste of time. And we've built up a investor base. We have a good investor base at this point. So I would say it's a piece of the puzzle. I'd say the real way to get more investors is to just start buying deals and start generating good returns for your investors.
Awesome. Well, I wish I can keep going on a number. We're definitely dwelling into the quick rounds. These are going to be quick questions, quick answers. You ready, sir?
Sure.
First question. What would you say makes you, Anthony, unique? What is that differentiating factor that separates you from the next guy or the next girl?
What makes us unique, I think, is pretty our hands-on approach. I haven't heard of, maybe besides yourself, actually, many multifamily operators doing the self-management. I think that really sets you apart, and especially the properties we're buying are local from where myself and my partner live, so we can get to the property in a half hour, each of them.
Yeah, we definitely have a lot in common. Yeah. And second question. What was the last book that you read, and what was the one thing you picked out from that book?
Last book that I read, I want to say it was The Miracle Morning by Hal Elrod. So it's not really a business book, but more of a mindset book. And just showed the importance of, if you're waking up early, you can get a lot more done. It wasn't more of that. It was more of, I think it's more of a shift, mindset shift of waking up early and or waking up right away. If you wake up right away, your day starts off to be a lot better than the previous day. If you kind of slept in or you woke up and then you went back to sleep, it could, the whole mood of your day is different. And I've experienced it. So trying to practice what he preaches.
Yeah, last question. You've obviously got a lot in your hands, about 30 million asset under management. You're going to be a very busy man. You're self-managing. What do you do
Yep.
for fun?
Uh, I like to run. I like to swim. I've been getting into trail running now. Basically, that means you run a hike, so you're running. It's very difficult, so I've been trying to get into that and playing guitar and playing piano and some other musical instruments. So and hanging out with family and friends. So that's important too. So try to get everything in one swoop.
Yeah, definitely. So if there's somebody listening and saying, "Wow, I like this Anthony guy," or "I want to know more about their podcast, Discovering Multifamily," or your company, what's the best way folks can reach out to you, connect with you?
Great, yeah, absolutely. So they can find me, our podcast on discovering multifamily. You can just type it in anywhere. You can find it, iTunes, Spotify. But what I would say is we have a special report on our website. It's called How to Leave Your 9 to 5 and Be Financially Independent. So you can find that at Red Knight Properties. It's free right now. And you can find that at redknightproperties.com, which is my company's website. It'll actually pop up, and all you need to do is put your email in and you'll get it. So it's a good guide to understand how real estate really builds wealth and passive income and cash flow. So we offer that for free, and then you can reach out to me on LinkedIn, Facebook, Twitter, Instagram. Just by my name, or you could do it by Discovering Multifamily or Red Knight Properties.
Fantastic, Anthony. Really appreciate you. Appreciate your time. Hopefully, talk soon.
Really appreciate it all. Thank you.